name is Brett Hatcher with the Hatcher Group, and this is our second webinar that we've done here. You know, like I said in our first webinar, I get a lot of calls with newer people looking to get in the industry, or, you know, some seasoned people who are doing development. As the self-storage industry is starting to, you know, move a little bit, we need to be aligned with the market, have our ear to the ground. And my team, you know, we're on the phones all day, every day, you know, learning and figuring out what is going on, you know, and especially in today's market as overdevelopment is starting to happen. And so I wanted to have these quarterly to kind of get everybody just quick, you know, I think today's will only be 20 minutes or so, you know, just an understanding of what's going on. So one thing we're going to focus on today, and the main thing we're going to focus on, is underwriting. How do you look at the value of your storage, you know, your storage, or if you're looking at buying one, or you're looking at building one? And, you know, one of those main things that we're going to focus on is that there's the buyer's perspective, there's a seller's perspective, there's an appraiser's, there's a lender's. Everybody has a different view of what things are. So in today's agenda, we're going to go through the basic information needed to get started for underwriting. And this is whenever I do a proposal for somebody. You know, our goal, we did over 100 proposals in the first quarter, and we're on pace to keep that going for the year. So we'll look at 400 properties this year, and that's even portfolios that make it more. So when we're looking at this many properties, we're getting an idea of what's going on in the market. And so when we're doing a proposal for somebody, we're looking at an evaluation, which is absolutely free if you ever are looking for one. The basic information we need to get started, and then putting that information, kind of, you know, putting it into our analysis and kind of spitting it out, and then understanding the seller's, buyer's, appraiser's vantage point, and then lastly, and I think we're probably all experienced this if you're an owner, or real estate taxes, because they're going up, values are going up, they've been going up, and now it's time that a lot of the school boards and everybody are chasing real estate values and trying to get more money to increase their budget. So that's a very important topic on the forefront. So, you know, when we look at doing a proposal, the main thing we start when we look at is, I like to get a trailing 12 profit and loss, or last year's. Realistically, I like to look at the last 24 months of what you've done, because with the market that we've had in the past, you know, since 2012, I mean, really it's like 5 or 6 years, we've seen tremendous growth in rents, and now we're starting to see overdevelopment where rents are starting to flatten out, or, you know, in some markets are going to start declining, especially in those hotter markets, the Denvers, the Nashvilles, the Dallas. I mean, some of them haven't quite hit yet, but some of them have. So we look at the profit and loss. We also get occupancy statistics reports and a management summary. And occupancy statistics reports, if you don't have SiteLink or, you know, one of the softwares, this is essentially a one-page report that has how many of each type of unit you have, what's the current rent, how full is each one, and then you have your management summary that breaks down, you know, delinquents, everything that goes into it. Another great thing to have is the tax bill. We don't always get it because we can pull a lot of information from the auditor's website, and we're really going to dive into that a little later. And then lastly is the note if the debt has to be assumed. I honestly haven't done a debt assumption since 2011, just because rates have gone down, and it's made more sense for a lot of people to defease the loans. Or even pay to get out of their loans, just because interest rates are so low. However, we're going to be in the market now where we're going to see debt to be assumed as a positive thing. The one downside to assuming debt is, you know, if you only owe, you know, 50% on your property, somebody has to come in and put 50% down, which isn't always, you know, a favorable thing for all buyers. So like I said, occupancy statistics reports, a management summary report, this is what they look like, just to give you an idea if you've never seen one, if you go off of something else. These are SiteLink reports right here. Left is the occupancy statistics report. The right is the management summary. And by the way, I will have this recorded and put on the website for anybody who does want to see this at a later date. As well as, and like I said, profit and loss is one of the main things we derive what we're looking at the value of a property. So what I'm going to do is I'm going to move over to an Excel spreadsheet right now. You know, we have a proprietary program we use, but this is to simplify things. See if you actually can drag that this line up right here, so I can zoom in or zoom out a little bit. Right, this line right here, and then slide it up. No, it's all right. We'll work with it. We'll just start at the top here. So, you know, when I got the occupancy statistics report, the first thing I do is I plug that into our system. We have a program that we have designed for the whole entire rental study, demographic study, income, expenses, and everything. So the first thing we do is with that occupancy statistics report is we plug that into a unit mix, stay at the top. And that allows us to, when we look at that, it gets the gross potential rent, and it puts in how many of each unit, and it gets the total square footage. So let's say, you know, we're going to, you know, this is a mock deal. Let's say, you know, we have all those units, they add up to 70,000 square feet net rentable. That does not include if you have hallways, an office, or anything like that. That's a net rentable. That's actually what makes you money. So we have 70,000 net rentable square feet at 600 units. And we're going to look over there in the current column. That's basically what we're going to focus on today. We'll look on the pro forma a little bit towards the end, but in the current column, when you added up all those units, if they were 100, say you had your storage facility of the 600 units, every single one was rented at market rate, everybody paid their rent, you would bring in $1 million in revenue. So the line beside it is $14.29 a square foot. You might be like, well, it's not like, that is on a yearly basis. That realistically would be about for a 10 by 10 would be like $1.20 probably, or something along those on an average. So you're getting $14 square foot rents. I would say at $14 square foot rents, you're not in the Midwest as much unless you're in Chicago. You know, you may be in the Carolinas, although they're starting to get closer to $1 a square foot, which a month, which would be $12 a square foot yearly. And so, you know, you have $1 million gross potential rent. If you get everybody, the potential is to bring in $1 million. When you look down at that gray line, 2 lines down, the effective gross revenue is your actual revenue. So this property brought in $850,000 for, you know, let's say the last trailing 12 months. And when you look at the economic vacancy, you might say, well, Brett, I'm 95% full. I'm not 85% full. I'm 95. You know, so you look at that economic vacancy. We're backed into that number based on the amount of revenue you bring in versus what your gross potential is versus when you look at, you know, a physical occupancy. So keep in mind that's economic versus physical. Economic is actual revenue brought in versus your gross potential, where physical is your, you know, your actual square footage or the amount of units. And then we're going to plug in your late fees, your merchandise revenue, your insurance, if you have truck rental. Some of these, you know, like these numbers right here are pretty basic, and although I meant to put 35, we put 3,500 on admin fees. I put an extra 0 in there because you're going to do admin fees at 35,000. So at $93,000 in other revenue, you know, that's, or you know, about, you know, actually it's not that much. You know, at that number, you're going to be fine. People don't move that cap rate. Keep in mind if you ever have truck rental, and let's say you just kill it and you're bringing in $65,000, $70,000, a buyer may not look at that the same way you look at that, and they may not cap it at the same rate. And by cap it, I mean they might put it at the same capitalization rate when they look at the overall NOI. So, you know, or a cell tower or something in the big revenue. But if you get in here and you got $25,000 on NFL fees and, you know, $10,000 on merchant, $5,000 on insurance, and $3,500 on admin, they'll be fine with that. That's pretty typical. NSF fees at 25 might be a little high. That'd probably be a market that you'd actually have a little trouble getting your rents in. But overall, your actual gross revenue for your non-rental or for your all-in is $893,500 or $300 there. So that's your actual revenue that you have. So when we look at this, and for those folks that are really new to this industry, just to give you an idea of how we value these things, it's your income minus your expenses, and that expenses does not include depreciation, amortization, any personal write-offs. It is what it costs to operate the property. It's your income minus your expenses, your actual expenses to operate the property, and then that gets your NOI, and we do it at a cap rate. And that, when I say cap rate, that's your capitalization rate. That's the rate in which they want a return for the buyer wants a return. So an easy way to say that is if a buyer is buying a deal and they want a 10 cap, they want a 10% return without debt, without leveraging it, and the NOI is, let's say, $100,000, they want a 10 cap, they're going to pay $1 million for that asset. So the higher the cap rate, the higher the return, the lower the cap rate, the lower the return, but the lower the cap rate, the higher the price. You know, they coincide with each other. So let's scroll down into the expense section. So I'm going to walk through what we might see on the expenses. And this would be a typical deal for a 70,000 square foot facility. This would be built, let's say this built about 2012. So, you know, they came out, their real estate taxes were probably 65, 70,000. And over the years, their taxes have gone up, they've gone down, and now they're, you know, at $95,000. You know, certain markets are better. You know, you can be in California at one rate and, you know, Kentucky at a different one, or, you know, Colorado versus Florida. So each state is different in the way, you know, some are a little bit more conducive to lower, and some are just kill you, you know, they'll burn you on the cross with the real estate taxes. So, you know, and when I look at this deal, this is 70,000 square feet. This is institutional grade asset. This would be something, if you built this thing and you build it up like this, you could sell it, and you're talking, you know, any of the private equity companies, the REITs, they're going to buy it. You're in a major market, you know, let's just say this is in, you know, Jacksonville, Tennessee, or Jacksonville, Florida, excuse me. That's what this size property, you know, we would be looking at. So your taxes are $95,000. You know, insurance, I have it at $6,600. Now I say this in Jacksonville, Florida, but if you're close to the ocean, it's going to be a lot more. This might be better to say Nashville, Tennessee insurance. You know, your insurance is going to be on 70,000 square feet, anywhere from $4,500 to $8,500. If you're in, you know, Tornado Alley, if you're near an ocean, it'll go up. So, but this is more of an industry average, in my opinion, of looking at a lot of the stuff that we're looking at. Not earthquake, not any of those type of things. So that is basic. I mean, you can be at Tornado Alley and they're $40,000, $50,000. I've been on the beach in Florida or in Texas and seen them at $80,000. You know, that's just kind of the territory you're in. The utilities here is $14,400. That's a climate, non-climate controlled building, no elevator. That's, you know, majority non-climate drive-up storage units. You know, if you get into these big multi-story places, you're pushing $25,000, maybe even $30,000, depending on how cool you and how, you know, what market you're in. If you're in South Florida, you're going to cool it a lot more than if you're in Columbus, Ohio, on a multi-story. But this would be kind of your average if, you know, you had 70,000 square feet and 30% were on the climate controlled side. Bank and credit card fees, you know, this is an average. What I like to do, if someone said what's the average, I would say I like to take 80% of the effective gross revenue and take about 2 and multiply that at about 2%. But again, if you're in a bad neighborhood or in a rougher neighborhood, you may have a lot less. If you're in the very affluent areas, you may be 85, 90% credit card. So, you know, that merchant fees can swell back and forth, but that's pretty typical. Advertising and marketing. I look at this number, and this would be a stabilized asset. You know, the biggest swinger on this right now is spare foot. If you own a property, I'm sure you use spare foot. You know, they're going to charge you 1.5, 1.75 times whatever the first month's rent is if they get somebody. I've seen people with, you know, $40,000 a year in spare foot, more on the lease-up side of things. But once you're stabilized, you have the website, you know, you have your SEO, and you have a lot of that. You know, you're anywhere from the $7,500 to $12,500. Again, this all can change. Keep in mind on all of these, and that's when you look at $400 a year, and our team does. We understand that different markets are different, you know, because I may look at one in, you know, Mississippi, and the guy spends $800 a year and has a website and is full. You also may look at one in Atlanta where you may be in one of the more competitive areas, and it could be 25. So when you're looking at the different markets, this will change, and, you know, that's why, you know, obviously this gives you an idea of how to look at it, but it's important if you really get serious about what a value is, contact us, because we're here to help. We do the analysis for free. It's essentially an appraisal, but it's better, in my opinion, because you're getting a real-time. Appraisers kind of can be swayed back and forth sometimes with comps. But, you know, so that advertising budget can move. But 12.5 is about average of where we see, you know, the more SEOs and the Google AdWords and all that stuff, it gets a little bit more expensive. As for payroll, I mean, I like it at $1 a square foot until you get to, you know, a certain number. You know, you get too big, you know, you get 200,000 square feet, you don't need a 200, or, you know, you don't need, you know, that big of a, you don't need $200,000 in payroll. You know, if you're looking at a deal that's under 40,000 square feet, it's really hard. That's why a lot of deals under 40,000 square feet don't make a ton of sense, because it eats up your expenses if you have somebody in the office, unless your rents are just crazy rent, you know, unless you're getting $3 a square foot a month in rent. But keep in mind when you're looking at these, payrolls, if you're, you know, you're still going to have a full-timer and at least one part-timer if you want to be open 6 days a week. You know, a 70,000 square foot deal, you may have a full-timer and then, you know, a part-timer that works quite a bit, a bonus structure. You know, a lot of the institutions like to be in the 60s on deals like this, but then move into the 70s. And, you know, as the job market becomes, you know, a little bit more competitive out there, you got to pay the right people. And I can't express that enough. You know, I've looked at so many deals where buyers come in, change out a manager, and do really well with a property because they get a great manager. I mean, self-storage is a business. It isn't a passive real estate investment altogether, unless you have a third-party management company, and then it can be passive for the investor. But it is important because that management company is going to keep tabs on that manager, train them, make sure they're, you know, following up, make sure they're doing the right things. But $1 a square foot is about average there. On the repairs and maintenance side, 15 cents to 30 cents, depending on the, you know, the multi-story is going to be higher with elevators and stuff like that. The age of the property, you're getting closer to 25 cents a square foot. But, you know, it all depends on the asset, the quality, the CapEx, what you're looking at. If you build a new property today, you wouldn't expect to spend 15 cents a square foot. It's going to be lower. G&A, you know, that's just your, you know, expenses that pop up you aren't expecting. Office expenses, you know, postage and stuff like that. You know, you're typically in the $3,500 for an asset like this. Telephone and internet, $3,500, pretty self-explanatory. Landscaping and snow removal, I'd say $6,500. If you were in Michigan this year, you got nailed with a lot of snow removal, and it's probably higher than this. If you're, you know, if you have a lot of grass and you're in the Carolinas, you're mowing year-round. So, you know, it can fluctuate. So I like it at $6,500 there for an asset of this size. And then when we look at like software, you know, this is a site link for, you know, site link would charge probably this much. So again, I'm just throwing this out there as general rules, but they're very, you know, it's important to understand them or to get a professional when you're looking at this. But just as a general rule of thumb, when you're looking at this, you know, that's kind of the way, a general rule of an industry standard that you may look at this. And again, everything, this is a business, so that's why when we look at 400 of these a year, we've got to make sure we're even like sharpening our pencil and understanding every detail that goes into there, because it is easy to not understand or misinterpret an expense, or, you know, what that expense is, you know, because so many times the owner runs the property themselves, so $70,000 is $12,000, and they want it to be, you know, and that goes into the different views that we'll, you know, I'll discuss here in a second. But, you know, if the property is ran by, you know, your son, and you know, he has ownership in the property, and you have it at $12,000 a year, you got to realize as a buyer, any buyer comes in here, they got to put on a payroll. They've got to, you know, do that, especially on the smaller assets. When you're looking at the smaller assets, you know, they're like, well, my wife runs the property, you know, and she does it part-time. Okay, well, we got to replace that. Always keep in mind, if you own a property, when you look at the value, it isn't necessarily your NOI that is going to be the value of your property when you sell it. Now, if you get a refinance, that's a different story. But if you're going to sell it, you got to realize the person coming in here needs to operate it in the same manner in which you do. Which leads me into the taxes. It is the biggest concern in today's market. We're seeing values spike. School boards are going after their money. Their budget's going up. Cost of everything's increasing. You know, they were getting hit in the downturn of the market. Now it's time to come back and recoup, you know, and go back after some of those values, especially as we see sales go out there. Everybody hears a 6-cap deal that sold or 5-cap deal that sold, or he got 100 a foot, mine should be 100 a foot. Well, the school boards are thinking the same thing in regards to that. So payroll and real estate taxes are two big things to focus. You're like, oh, well, I know my NOI. Well, make sure you understand that, or, feel free to call us, and we're happy to voice our opinion. So you go down here, and I have this expense load at 32% of the gross of the revenue. That's a little bit light. I think your industry average is closer to 36 to 38%, especially with real estate taxes, as they continue to go up. Scroll down just a little bit. So I want to look at this deal. We have an NOI of a little over $600,000, and like I said, we're selling this in a pretty good market here. We're probably listing this thing in the high fives, right around 6, expecting it to sell at 6 million, 6% cap, $10 million, and then when we look at the pro forma side, a lot of that is just when I moved the numbers, I bumped the expenses a little bit, and I increased the revenue. I did a rent bump on the pro forma side. So somebody, I bought it at a 6 cap at $10 million, but when I moved the rents and I really micromanaged it, I was able to push it to a 6.89% cap, and if you borrowed at 4.8, 4.9 right now, you would be in the low double-digit returns, which is a great deal for a Class A minus asset. So we got 8 more minutes. I'm going to wrap this up. Let's go back to the PowerPoint slide. And so again, we've got those real estate taxes, decreasing value of the sale prices versus what the auditors. So many times these owners may have bought the property in the downturn. You built it back in 2002. You built it in 97. I want to look at the existing small properties, in 2005, let's say you built it in 99 and 2005 was worth 1.2, and people were offering you 1.9, $2 million, or let's say $2.2 million, and you're like, I didn't sell. Well, then 2010, the market crashed, and, and everybody, they dropped everybody's values, and you went and appealed it, and you got it down to $800,000, and they've slowly ticked you up over the last 8 years. You got $1.3 million, $3.5 million. And then all of a sudden you got to sell. Well, I got to sell the property at, and I, come to you and I say, Mr. Seller, I can get you $3.1 million for this asset. And you say, if you can bring me that offer, I'll do it. When I'm underwriting this deal, I've got to realize that the buyer's going to come in here and say, well, Brett, their taxes are based at $1.3 million. If I buy it at $3.1 million, I'm going to be over double the taxes in there, which takes your NOI down, which means I can't pay 3.1. I got to pay 2.7 for it. So you've got to keep in mind that people are doing have to understand that as an owner, you can't get completely dinged. They're not going to, so they can't be completely dinged, and I've doubled their taxes. The NOI goes down. Now all of a sudden, if I come to Mr. Seller, I can get you $2.7 million. Like, I'm good, I'll hold. I'm making good money on this. So right now in this market, we're trying to find ways to get around that to alleviate that big hike in the taxes. One way is the LLC transfer, a structured sale. There is no foolproof way. At the end of the day, if they find out that the taxes, that say I bought that property, I was the buyer, and I bought that property for $3.1 million, and the school board drives by and sees, CubeSmart or Extra Space is managing it, and that sign changed, and they went to the auditor's website, and, I put 20% down on that $3.1 million, and, they realized that I got a $2.4 million note. They're at least going to assess me up to that amount. So as a buyer, what we're doing and trying to do is bridge that gap. The buyer can't take all the risk, so the seller and the buyer, and they may come in and say, look, I can give you 2.95. Let's split the difference. If I get caught, my numbers are going to be a little tight. If I don't get caught, I've got a pretty good return. An existing larger property, you were valued at 4.8, you went in and appealed the downturn, those got the most write-downs. In 2010, you're at 3.2, I sell it for 6, and then today those big existing deals are selling for at least double. Those are the scary ones, because then the risk level for the buyer is getting higher, and so they've got the bigger risk. So, you got to try to bridge, you have a bigger gap to bridge in the sense of the risk for the buyer buying that. And then the other one, and this is a really hard one, is these new builds, and this is a small build. Let's just say, you built 50,000 square feet in a good market, and you're valued at 1.1, but you have $5 million into it. You're going to sell it for $7.3 million, make $2.3 million on your new development. You're all excited. Well, the problem is the auditor has you, because you pull permits at $1.1 million. They don't know any different. But if this somehow, again, the sign changes, if the title company records the deed and they reassess upon sale, in Michigan they do state equalized value, which is a little more black and white. In other markets, it can be different. And so when you look at that, that's the biggest jump. Now all of a sudden, your taxes may go 5x, and now it really might hurt the deal. Now you're really looking at the value, instead of saying 7.3, they may be looking at you going, I can't take that much risk on. I got to be at 5.9, and then you don't have a deal. So it's trying to find that happy medium on the new build. So and let's go to the next slide. So I'll show you what the how does the investor look at the taxes, and what can we do to alleviate some of the tax hikes? But, you have the seller's current view. Hey, I'm paying $2 million. I'm selling it for $4 million. Now you have the buyer's current view. Hey, I'm buying it for $4 million. He's looking at it's valued at $2 million. My taxes are going to double. The appraisers and lender are going to lean more towards the buyer side of things, obviously, because they're going to be the largest owner in that. So you got to understand, as a seller, you may be paying taxes at a lower value, selling at a higher, but that buyer coming in is going to bump those taxes up some. The sum question is the hard part. Is how do we quantify the level of risk? If the taxes are going to double, and the buyer comes in and just bought it and it got recorded, all of a sudden the taxes doubled. They went from buying a 6 cap to a 4.5 cap. They're not going to do that. But all of a sudden, they do what we call as an LLC purchase or a drop and swap. That is where an owner creates an LLC. So let's say it's self-storage LLC. They create self-storage's LLC right before closing. They don't assume the existing LLC. Typically, I've never done that because of the liability of stuff that's happened in the past. Got 2 minutes to wrap this up. So they want to make sure that they understand that they're getting a brand new LLC. So now they're buying the entity. They're not buying the actual real estate. They're buying the actual entity. So they drop that entity into a new LLC. They swap out the owners. It's not recorded on the website or the auditor's website as a transfer of deed, like a typical arm's length transaction. And that allows the buyer to lessen the risk of getting caught. This is getting caught. The apartment market in Columbus has been getting nailed for this, because at the end of the day, people hear about the sales. They also, what they do is they can go look at the new LLCs that have been established. Then you can go look at your note that is online. So again, if you bought it for, it's valued at $10 million, and you bought it and there's an $8 million note on it and it's valued at $5 million.
When I considered it, I'd be interested in serving out his term. I don't want to run next year. So if you need to fill it with someone that's gonna run next year.
There we go. Sorry about that. We thought we had everybody muted, but somebody got up. So let's go back to sharing. So they'll take the new LLC, they'll get the new entity, take them over, but on the auditor's website, your note is still available to be viewed. So they may notice it's valued at $8 million. Well, if they go in there and say, look, you have a note for $8 million, it's valued at $5 million, it's pretty easy to say that value goes to $8 million. Now you're going to see, a $300,000, you're going to see a big increase in your taxes on that side. So the taxes go up. So now you see a buyer, you may do an LLC purchase, plan on going to $800,000, and if you get caught, deal's going to be tight. But if you don't get caught, you're going to get a little bit better cash flow. So you're leaving, you're sharing the risk with the seller and the buyer. The other thing is a structured sale, where you put 30% to goodwill, non-compete, personal property, etc. You put that to the non-real estate, and you put 70% to the real estate. So now on that $10 million deal, you look at that and you do a contract on the real estate for $7 million. Now they get caught. Now the taxes go from $5 million to $7 million. It's a little bit less of a hit to your taxes, to your revenue, but it's still going to hurt you. That one has lost in federal court, but it is still done very well. Like I said, the LLC I've never been caught in self-storage. It may have happened. I've never heard of it. The other thing is I've done stuff where sellers stay in the deal for a small amount for a year or two as part owner, like a non-equity owner, and then bails on it. Done in Pennsylvania on an 8911. They stayed on for 11% for zero cash flow for a year, and then they got bumped off to alleviate the taxes from getting triggered. So it's 11:31. I want to open it up to questions. If you want to jump off the call, feel free. I'm going to open up questions. So I'm going to unmute everybody. So if you are talking right now, please mute your phone, because I'm going to unmute. I'm going to unmute everybody. So does anybody have a question out there?
Scott? Hello? Scott?
Well, I'm just going to close it out because I think we've got our muting situation going on. So I'm going to go mute it. If you have a question, and share the screen again. If you have a question, call me, 61, that's my cell phone, even call me anytime, shoot me an email with any of your questions you have from what I've done. Again, self-storage is a business. This isn't, I just took you through the most general underwriting basics that there are. If you really truly want to know, reach out to us. We'd be happy to put something together for you. Or if you're fighting taxes and you need help, reach out to us. We're not just brokers, and it's always great to sell. We're happy to be a consultant to help you grow your property, grow your revenue, increase your value, and then someday, hopefully, we get to sell it for you. But not everybody is a seller today, and it completely makes sense. I'm always here. Call me anytime. I appreciate everybody taking their time today. We'll be doing our next call in December, which will be a year-end recap. I look forward to speaking in, and thank you, everybody, for coming.